You walk into a bank. You ask for a loan. The bank checks a screen, types a few numbers, and says yes. No vault opens, no pile of cash moves, but somehow new money now exists. That's the uncomfortable part. Because the biggest shortcut to power in the modern economy isn't oil or land or factories. It's the ability to create money by lending it. And almost no one understands how that actually works. This matters right now because debt is everywhere. Households, companies, governments. We're told banks are just middlemen, that they take savings from one place and lend them to another. That story is comforting. It's also mostly wrong. Here's the setup most people believe. You deposit money, the bank keeps it safe, then it lends that money to someone else. Simple, logical, reassuring. But if that were true, banks would be limited by how much cash people deposit. They'd be slow, careful, constrained. They're not. Here's what actually happens. When a bank approves a loan, it doesn't hand out existing money. It creates a deposit out of thin air. Your loan is typed into existence. On the bank's balance sheet, two things appear at the same time. An asset, your promise to repay, a liability, new money credited to your account. No one had to save first. No one had to lose money for you to gain it. The money supply just expanded. This isn't a conspiracy. It's not illegal. Central banks openly admit it. In fact, in many countries, over 90% of all money exists this way, as bank-created credit, which leads to the shortcut. Because if you can create money by lending it, the real limit isn't cash, it's confidence. Confidence that borrowers will repay, confidence that depositors won't panic, confidence that regulators won't step in. As long as that confidence holds, banks can grow enormous balance sheets with surprisingly little actual cash behind them. This is where leverage enters the story. A simplified version looks like this. A bank might hold $1 of real reserves, but it can lend out 10, 20, sometimes more. Not because it's reckless, but because the system is built that way. Most of the time, loans don't get repaid all at once. Payments come in slowly, withdrawals happen gradually. So the bank rides the gap between promises and reality. And that gap is power. Because lending decides who gets to act today instead of later. Who buys homes, who starts companies, who survives downturns. Banks don't just respond to the economy, they shape it. Here's the hidden math that makes this uncomfortable. Interest. When a bank creates a loan, it creates the principal, but it does not create the interest. That extra money has to come from somewhere else in the system, which means, collectively, borrowers are always competing for money that doesn't fully exist yet. Someone has to win, someone has to default. This is why debt-based systems naturally push toward growth. More loans, more expansion, more pressure. If lending slows, money creation slows. If money creation slows, businesses struggle, jobs disappear, defaults rise. So banks are encouraged to lend, even when it's risky, especially when it's profitable. There's a quiet irony here. Banks are often described as cautious institutions, but the system rewards them for taking risks during good times and being rescued during bad ones. Because when large banks fail, the damage doesn't stay contained. Credit freezes, payments stop, confidence collapses. Suddenly, everyone realizes that money is mostly promises stacked on promises. This is why central banks exist as lenders of last resort, not to help banks, but to keep the illusion from breaking all at once. When things go wrong, central banks step in and create even more money to plug holes, to calm markets, to buy time. It works until it doesn't. Now, zoom out. This shortcut doesn't just affect banks. It shapes inequality. People who already own assets can borrow cheaply and buy more assets. Prices rise, they look richer. People without assets face higher costs and tighter credit. They fall behind. The system doesn't ask who deserves money, it asks who looks safe. And safety is often just past success recycled into future advantage. There's also a timing problem. When banks expand lending, economies feel strong. When they pull back, recessions begin. Not because people suddenly forgot how to work, but because the flow of newly created money slowed. This makes banks incredibly influential without ever appearing in charge. They don't pass laws, they don't give speeches, they approve loans. And with each approval, they quietly decide what grows and what doesn't. Here's the contrast no one likes to talk about. We're told markets are driven by productivity, innovation, and hard work. All true, but underneath that story is a financial system where access to credit often matters more than effort. Two identical ideas, two identical people, one gets funded, one doesn't. Different futures. And all of it hinges on balance sheets most people never see. So why don't banks just create infinite money? Because confidence is fragile. If too many loans fail, trust evaporates. Depositors rush for exits. Markets panic. The shortcut only works as long as people believe it will. That's the quiet risk built into the system. Power based on trust rather than substance. Every credit boom carries the seed of a crash, not because humans are greedy, but because the math demands restraint in a system that rewards expansion. Which leaves us with an uncomfortable question. If most money is created by private banks, if interest demands constant growth, if stability depends on confidence that can vanish overnight, who really is in control of the economy? And what happens the day this shortcut stops working the way it always has?